Let's talk about banks. Not in a scary way, not in a conspiracy theory way. Just clearly. What are they? How do they actually work? And what does Bitcoin do differently? Because here's the thing. Most people use banks every day without really understanding what a bank is. And that's not a criticism. It's by design. The simpler banking feels, the less you question it. The less you question it, the more the system depends on your quiet participation. So this episode is about pulling back the curtain. Not to tell you banks are evil, not to tell you to close your account tomorrow, but to help you understand, clearly and without drama, what the system actually is and what Bitcoin is offering as an alternative. No villain framing, just mechanics. When you put money in a bank, something surprising happens. The money stops being yours in the way you might think. Legally, when you deposit money into a bank account, you're not storing your money there. You're lending it to the bank. The bank takes your deposit, adds it to a pool with everyone else's deposits, and lends most of it out to home buyers, to businesses, to other financial institutions, and it charges interest on those loans. That's how banks make money. They borrow from you cheaply, paying you a small interest rate on your savings, and lend it out expensively. The difference is their profit. This system is called fractional reserve banking. It means banks only keep a fraction of deposits on hand at any time. The rest is out in the world as loans. Think about what that actually means. If you have $1,000 in your account, and your bank has a reserve requirement of 10%, they're only required to keep $100 of your money on hand. The other $900 is lent out, earning interest for the bank. While your account still shows $1,000, the money appears to exist in two places at once. In a sense, it does, until everyone tries to collect it at the same time. Which is why, in a crisis, if everyone tries to withdraw their money at once, the bank doesn't have it. That's called a bank run. And it's happened, more than once, throughout history, including recently. Silicon Valley Bank collapsed in March 2023, almost entirely because of a bank run, one of the biggest bank failures in American history, and it happened over the course of about 48 hours. Now, in most countries, there are deposit guarantee schemes, government-backed protections that insure your deposits up to a certain limit. In the US, that's $250,000. In Australia and the UK, similar protections exist. So for most people, most of the time, your everyday savings are protected. But the protection has limits, and the protection depends on the government being able to honor it, which depends on the government, which is again a middleman. Here's where it gets personal. Banks have significant power over your account. They can freeze it if they suspect fraud, or if they receive a government order, or sometimes just because their automated systems flag something unusual. They can close it, with notice in most cases, but still without your agreement. They can decline transactions if you're sending money somewhere they've deemed high risk, or to someone on a restricted list, or simply because their system doesn't like the pattern. They can also charge fees, maintenance fees, transaction fees, international transfer fees, fees for falling below a minimum balance, fees for going over a limit, fees for using an ATM that belongs to a different bank. And they can change the terms, your interest rate, your fee structure, the conditions of your account, with notice, but not necessarily with your consent. None of this is hidden. It's all in the terms and conditions that nobody reads, which is exactly how it's designed to work. Now let's look at what Bitcoin actually changes. When you hold Bitcoin in your own wallet, meaning you control your own private key, which we talked about in episode 2. Nobody can freeze it. Nobody can close it. Nobody can decline a transaction. Nobody can change the terms. Because there are no terms. There's just math. You can send Bitcoin to anyone in the world, at any time, without asking permission. A small network fee applies, paid to the miners who process the transaction. But there's no bank taking a cut, no foreign exchange markup, no 3 to 5 business days. Consider what that means for someone sending money across borders. A woman sending money home to family in another country might pay fees of 5, 8, 10% through traditional wire transfer services. She might wait days for it to arrive. She might need documentation, a bank account on both ends, approval from intermediaries. With Bitcoin, the transfer is peer-to-peer, direct, no intermediary taking a percentage of money that someone worked hard to earn. That's not a hypothetical use case. It's one of the most concrete, real-world ways Bitcoin is being used right now, by people who've been failed by traditional financial systems, or who simply don't have access to them. And nobody can inflate it. We covered this in episode 2. 21 million, fixed, forever. No central bank can decide to print more because the economy needs stimulus, or the government needs to fund something. The supply is set. What exists, exists. What doesn't exist can't be created. That's a fundamentally different relationship with money. Not better in every situation, but different in ways that matter, especially if you've ever felt like the system wasn't quite working in your favor. Now, and this is important, I'm not going to pretend banks are useless. They're not. And a fair comparison requires being honest about what they do well. Banks are familiar. They're integrated into almost every part of modern financial life. Your salary, your rent, your bills, your tax. You can't pay most of these things in Bitcoin today. That may change over time. But right now, banks are the interface the world runs on. Banks also offer things Bitcoin doesn't: customer service, dispute resolution, fraud protection. If someone scams you out of money via a bank transfer, you have options. You can call the bank. You can dispute the transaction. You can involve regulators. If someone tricks you into sending them Bitcoin, that Bitcoin is gone. There's no customer service line, no dispute process, no reversal. The irreversibility that makes Bitcoin powerful is also what makes mistakes permanent. That's a real trade-off, and it's one you need to understand before you engage with it. So who wins? Neither, or both, depending on what you need. Banks are good at integrating into the existing financial system. They're regulated. They're familiar. They offer protections that Bitcoin doesn't. Bitcoin is good at being something banks fundamentally cannot be. Money that nobody controls, that can't be inflated, that can be sent anywhere in the world, without intermediaries, and that belongs entirely to whoever holds the key. The most financially literate people in the world don't usually choose one or the other. They understand both. They know what each system does, where each one has limits, and they make decisions accordingly. That's not a complicated position. It's just an informed one. And informed is exactly what this channel is trying to help you become. Because the goal was never to swap one system of dependence for another. The goal is to understand your options clearly enough, to make your own choices, with your own money, on your own terms. Banks and Bitcoin are not at war. They're different tools, built for different purposes, with different strengths and different limits. What you need to know, and what most people are never told, is how both of them actually work, because you can't make good decisions about something you don't understand. You've now finished the Foundations arc. 4 episodes. The why, the what, the truth about risk, and the comparison that puts everything in context. Next, we're getting practical. Wallets, keys, how to actually hold Bitcoin for the first time, safely, clearly, and without the fear. Bitcoin for Girls, the building of a beautiful future. See you next episode.